Hey, good morning, everybody, and welcome to this July 15th, Tuesday, July 15th, 2025 edition of Trading Places live at earningsbeats.com. I'm Tom Bowley, Chief Market Strategist here at Earnings Beats. It's a pleasure to be with all of you this morning. Well, we got another CPI report out. I can give you all the details here in 1 second, but essentially it was about what everybody was expecting. As far as the core rate went, we were expecting, I saw some headlines this morning, which always cracked me up. And one of which said, that inflation was surging again. But the thing you have to understand is that inflation was expected to go back up from last month's reading. And so, we shouldn't be that concerned. Actually, on the headline number, it matched. So we were looking for a 0.3% rise for the month of June in the headline CPI, and that's exactly what we got. But if we strip out food and energy, we were expecting 0.3%, and we got 0.2%. So if anything, we actually had a little bit better report than expected. But again, sometimes you look at the headlines, and what they were talking about is the fact that last month it only went up 0.1% on the headline number. And this month it was 3%. So therefore, in their eyes, it was surging. But that was exactly what the market was expecting on the headline number. And like I said, if you strip out food and energy and we look at the core number, we actually have a number that came in below expectations. So all in all, pretty good numbers. I wanted to give you a quick update on the futures because we were seeing mixed futures, and everything turned up a little bit, not a lot. Actually, the Dow Jones still showing red. That may have gone back down again. I'm not sure. But right now, the diamond's down 0.11%, so just fractionally. The spider is up a little bit more than 1/3%, so almost 0.4%. QQQ was having the best reaction, but it was already up because of NVIDIA news. We'll talk about NVIDIA in just a minute. But QQQ up 0.7%. And then the IWM small caps up almost 0.2%. Small caps were down prior to the inflation news coming out. So we've definitely seen a little bit more of a positive spin to the upside after the CPI news came out. So if anything, I think that just maybe gets a little bit more of the fear out of the market. And that fear has been coming out for some time now. It also continues, in my opinion, to set the stage for the Fed to cut rates at this month's meeting. I don't know if they will or not. I feel like Powell's pretty hard-headed, very hawkish. So I'm guessing that he's not going to cut, but I think he should. I still would not be surprised if the Fed cuts. I think even Powell, like I've said recently, I think even he has opened the door to a potential rate cut by saying he admitted last month that the Fed, if he had known that if it weren't for tariffs, he said the Fed would have already been cutting. So, now we got another month in where numbers are coming in below expectations. It's like, when is the Fed going to follow that data dependency talk? That's what they kept saying, and then when the data didn't support their views, then they said, well, we have to look out into the future. Well, give me a break. Just be consistent. I think the Fed, like I said, I don't think there's any coincidence by the fact that we've had 4 cyclical bear markets in the last 7 years. No other Fed, there's never been anything like that under any other Fed's watch. So you can say that he's a part of it. You can, I guess, put your head in the sand and think that he's had no part in this whatsoever, and he's doing a great job. And hey, everybody's entitled to their opinion. I think he stinks. I think he's absolutely been horrible. I've said that for years. I'm not just saying that for the last 6 months. I've been saying it for a while. I gave him benefit of the doubt for a while because of the pandemic. Who's got a playbook for the pandemic, right? So, hey, it's hard to say exactly. I thought I thought the inflation was transitory back a few years ago. So it's kind of hard for me to criticize the Fed for thinking the same thing. And like I said, I gave him the benefit of the doubt for a while, but he has consistently shown now for his entire tenure that he is late to the party. And we're going to see what happens in July. Is he going to be another month or another meeting late? Who knows? In my opinion, he should have been cutting all along. We should have continued to cut quarter point at each one of these meetings. And you say, well, we're sitting at all-time highs. He's done a good job. Well, we were sitting at all-time highs before the last cyclical bear market. We went down 20%. Why did we go down 20%? Is it a coincidence that we went down 20% after the fact he stopped cutting rates? I could argue that a lot of this last cyclical bear market was because of the Fed, because they got it wrong. So you think he's doing a good job. Maybe if you've just held in and you didn't lose any money as a result, maybe you feel fine. But for those that got scared out of their positions because of the huge drop and all the tariff talk and the fact that the Fed was buying into something that they didn't know would be there, they didn't know if the tariffs were going to cause inflation. So they're just guessing like everybody else. Unfortunately, they probably cost a lot of people a lot of money. Anyway, let's keep moving on. We'll see what happens at the Fed meeting later this month, but not really a whole lot we can do until then. Let's go in and take a look at what happened yesterday in the market first. So we start off, Russell 2000 led the action yesterday. We've been seeing a little bit better performance, relative performance out of small caps, also transports, which didn't have a very good day yesterday. Transports have been very, very strong over the last month or so. We'll look at that chart in just a few minutes or so, but you can see, most of the areas of the market were up yesterday. Again, transport's down, but I think some of that may have been just profit taking, normal rotation after a big move to the upside. But all in all, pretty decent action. When we look at the sectors, we had communication services and financials leading the action to the upside yesterday. Industrial's not doing bad as well. 7 groups higher, 4 lower. The only maybe head scratcher was a little bit of downside in technology, but otherwise, everything else kind of according to plan. Discretionary outperformed staples, although both consumer groups were higher. So all in all, I would say it was a pretty good day in the market. Energy took a little bit of a hit along with materials in the healthcare group and along with technology that I said earlier. But otherwise, not a bad day. We're somewhat overbought. Market's been straight up since the April low. I don't see any bad action, and I really don't see anything in my chart suggesting that we're going to have poor action ahead. The one thing that I would caution, and I usually do this monthly, is we're going into option expiration Friday, and the market's been pretty solid, meaning that there are a lot of in-the-money calls out there right now, not so many in-the-money puts. So you've got the potential, you've got incentive for market makers to pull some of these stocks down going into this week, maybe into the early part of next week. Again, I don't think it's going to be anything major, but would I be shocked by 2 or 3% pullback at some point? No. That would just be kind of a normal type pullback. So if you're worried about the market, personally, I would stop worrying. I think this market's in good shape. Again, it's overbought. We could see a normal pullback from time to time, but I see higher prices. I see the market setting up for higher prices in time. Whether it's today, tomorrow, next week, or whether it's 3 months from now, I see higher prices coming. So that's how I'm approaching the market. I'm staying on the long side. I'm staying fully invested. I feel like, we're going to pull back at some time, but I'm not going to sit back and get out of the market trying to catch a 1 or 2% pullback. If I think pullbacks are going to be fairly shallow, I want to stay long the market. And so that's kind of where I'm sitting right now. S&P 500, nice push to the upside off that April low. We continue to move higher. Today, maybe we get that first close over 6,300. We'll see. But at least we're going to get a pretty good start to the day. As I mentioned earlier, the S&P 500, I'll give you an update. SPY, which is the ETF that tracks the S&P 500. Right now, it's up 0.43%. So if you take 0.43%, well, that would be about 31 points would be 50%. So you figure it's about 25 points. That's going to take us to about 62.90 or above. And the all-time high close was last Thursday at 62.80. So there is a good chance that in about 20 minutes, we're going to open at an all-time high. The high that day was 62.90. That's the all-time high intraday. And based on futures right now, we're going to be right about that number, maybe even slightly above. So it could be another record-breaking day and doing it with lower than expected core CPI. Again, Fed, where are you? And I'm not saying this. Some people say, well, why do you want the Fed to cut? The stock market's at an all-time high. I had one person on YouTube comment a few weeks ago saying, why would the Fed cut? We're at an all-time high. The market being at an all-time high has nothing to do with Fed policy. I don't think that's in their mandate anywhere. There's two mandates for the Fed, and I don't remember position of the stock market being one of them. They're basically there to create jobs when they need to, when the economy's starting to weaken, which we've all seen signs of it. We had a negative GDP report. Why leave rates higher than you need them to be just because the market's at an all-time high? Are we going to try and wait for a recession? Just leave the rates up there, even though we don't need them up there? The only reason they went up as high as they did was because of inflation. So if inflation's not a problem, why leave rates high? Again, all you're doing is just forcing a recession that you don't need to, which Fed's been pretty good at. Maybe they will. Maybe that's part of what's going on right now. That's part of what's happened in 2025 is they let rates stay higher too long. They started cutting last year, which was the right move. They stopped, and when they stopped, 2 months later, we topped and the market goes down 20%. So you be the judge. Anyway, and NASDAQ 100 also moving up. We should be at an all-time high on the open today, with the futures up at 0.7%. They were almost 0.75% higher on the QQQ. So we should see the NASDAQ 100 setting a new all-time high at the open. And then we've got the IWM, which has been performing better than the NASDAQ and the S&P 500 over the past couple of weeks, which has been nice to see. It is lagging this morning. Part of what's going on with QQQ is NVIDIA. I'll show you an NVIDIA chart in just a minute. But NVIDIA was, they started, I think, delivering certain chips to China. Kind of the doors open back up again. And I'll come back to this IWM in a second. Let me just pull up NVIDIA. And if we pull up the pre-market, you will see NVIDIA up almost 5% this morning, up $8 to 172. So it should be another strong day for semiconductors. I saw AMD, Advanced Micro, up 5% as well. Going down the list, I mean, you got KLA Corp up 1.5%, Lam Research up 1.6%, Applied Materials up 1.8%. So, I mean, the gift that just keeps on giving, the semiconductors, when they get rolling, and we talked about this a while ago, when they get rolling, they are a thing of beauty to watch, especially from a long perspective, as they just continue to move higher and higher. Anyhow, back to the IWM here. Just wanted to point out that we remain well above that rising 20-day moving average, which is above the 50-day moving average. Everything still looks good here. To break out on the IWM in the short term, we're going to have to get through the 225 level on a closing basis. We're not there yet. Again, right now, IWM is this morning up. It's actually up almost 1/3 now, so it is gaining a little bit of steam, but it's up close to 224. So we need another dollar to get us into that breakout territory. May or may not happen today, but I do like the consistent push to the upside. And this all comes after that 20-day test. Remember that reversal? It looked like we were breaking down. That was on June 23rd, so just a few weeks ago. We almost broke down. Intraday, we were breaking down. We reversed back up. Very, very strong candle, and that's kind of what lit a fire under small caps. So anytime you get a false breakout, you got to be careful on the upside, because a lot of times that'll lead to some more downside action. Same thing to the downside. You get a false breakdown. Intraday, you got this big push to the downside, which from a technical perspective, if you've got a breakdown intraday, most retail traders would not be buying. I don't buy stocks when they're breaking down. So the reversal itself likely came at the hands of market makers. And so when you see market makers reverse stocks and hold key levels like that, many times that is the start of an uptrend. And that's what we talked about back on June 23rd, talking about the TNA, the leveraged product of the IWM. Let's see how many days this has been. So since that day, actually since the day here, it's been 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15 days. So 3 weeks, 15 trading days. But what I wanted to do was go in here and put in a rate of change. And we'll do a 15-day rate of change on. And you can see over the last 15 days. So since the day before we bottomed. So this is going back to June 20th, Friday, June 20th. Since Friday, June 20th, the IWM has run up 6.68%. And I'm going to see what the others, QQQ, that's up 570. And the Spider is up 514. So small caps have actually outperformed both the Spider and the QQQ. So both the S&P 500 and the NASDAQ 100 over the course of the last 3 weeks. Now, if we go back and look at that IWM again, there's the 6.68%. But what if you did the leverage? 3 times 6.668, 6 2/3 is about 20%. So if you pull up the TNA, and you'll see the TNA is up 20.1%. So that's what I was talking about back here. When you get a big reversal off of a key moving average like this is the time to not only think about the IWM, but also as a trader, if you're going to catch an uptrend, I would want to catch it with the triple leveraged TNA, which is what I've been trading and continue to trade. Again, I don't know, I like tripling my returns. Now, the beauty of getting into the TNA here on this reversing candle is that what if it breaks down? What if the IWM breaks down? All I'm doing is I'm in the triple for one day. The day of the breakdown, I get out, I exit. So when you're trading leveraged products, whether it's the TNA, whether it's the TQQQ, which is the triple QQQ, doesn't matter which triple you use. You want to try to enter when you have very, very little downside risk. So if you're trading this as though the 20-day moving average is your key level to watch, and that's what's going to take you out is a close below the 20-day, entering on a reversal on the 20-day moving average just makes perfect common sense because you can manage your risk better. Successful trading is all about managing risk. Everybody thinks, oh, you got to hit 80%. You need 80% winners. No, you don't. You can easily make a lot of money in the stock market, getting right 50% of the time. But if you're winners, if you hit your winners, if you enter at the right time and your winners go higher, you can obviously have some pretty decent wins. And if you're to the downside, if you're entering close to a support level, key support level, you can put your stop in tight. So yeah, you might be losing 50% of the time, but when you lose small amounts. That's the key. Again, it's about managing risk. It's not about being right all the time. That's why if things go against you, I took a mind over money course many years ago. It was probably 20 years ago. And one of the things that they talked about was the fact that humans cannot accept a financial loss because it means that you're wrong. And a lot of people have a big problem admitting that they're wrong. They get into a stock, they think it's going to go higher. When it comes back down, they just think, well, I should buy more because it's going to go higher. I heard it at the water cooler. Somebody told me it's got to go higher. That's why you get in a lot of trouble. And that's especially the way when you get into a cyclical bear market. When you're in a cyclical bull market or a secular bull market advance, you can pretty much throw a dart at stocks. Most stocks go higher. But when you start going into a sideways market where you get a lot of rotation, a lot of consolidation, a lot of back and forth whipsaw action, or worse yet, a cyclical bear market where most stocks are going lower, doesn't work. You can't just pick anything. You got to be a little bit more astute than that. Anyway, TNA, I think, is a great alternative to the IWM. The problem is with new money, like right now, if you get in, the IWM is sitting at 223 and the 20-day moving average is at 217. That's where the problem comes in. So now you got $5.50 to the downside. $5.50 to the downside is roughly 2.5% on the IWM. The TNA, you can triple that. So that's 7.5%. So the problem right now jumping into the TNA is that you've got 7.5% downside risk before you hit a key support level. And that that is up to each individual. Are you willing to take 7.5% risk to jump into the TNA at this point? I don't know what to tell you on that one. That's up to each individual. But when you pull back, if the IWM pulls back, and remember, I'm always talking, even with a leveraged ETF, I'm talking about the individual stock or the individual ETF, the underlying index, if you will, or underlying ETF. In this case is the IWM. I don't trade based on the TNA. I trade based on the IWM. Let me just pull up that TNA again for a second. So let's say, so right here, you see this low on January 13th. Looks like we were down somewhere around 213 level at the open. And then we closed at like 216. If you had bought, let's say you saw that reversing candle and you said, all right, rather than get in the IWM, I'm just going to buy the TNA. I'm going to hold it. Now, the IWM right now is at 223. And you see that IWM back on January 13th closed around 216. So we're up $7. So we're up 3.5%. So if you'd gotten into the IWM, you'd be up 3.5%. So the rational way of thinking is, oh, well, if I buy a triple, I'd be up 10%. I mean, if the IWM's up 3.5%, I should be up 10% in the TNA. So I want you to look at what the TNA was back on January 13th. So January 13th, the TNA it closed at 39.24. Right now we're at 36.84 as of yesterday's close. So we're down $2.40. We're down $2.40 from 39.24. So we're down about, I don't know, 6-7%. IWM is up 3.5%. Why would this triple ETF be down 6 or 7%? Erosion. The volatility, the up and down erodes the TNA. The TNA is a lot like, I mean, derivatives are used in order for the triple leveraged ETFs to track on a 3-to-1 basis. They use the leveraged products use these derivatives, options, think options. And if you hold an option for 6 months, over a 6-month period, if the price goes nowhere, your option goes down, right? Why? Well, it's the time element. It's similar with these leveraged ETF products. So you can't buy and hold. I get this all the time. People say, well, I'm just going to, if you like the IWM, I'm just going to buy the TNA and just hold it. Well, during the uptrend, you're going to love me. But over time, if the IWM goes up for a period of time, then comes back down, we're going to run into the same thing. The TNA over time is not going to triple the IWM. It's just the way these products work. The time to be in them is during the trend. Like right now, we're uptrending with the IWM. That's when you want to be in the TNA. When that uptrend ends, we break the 20-day, we go sideways for a while. That's where you're going through the period of erosion. And it's just the way compounding works. If you look at, if you just pull up numbers and just assume the IWM goes up 1% every day for 10 days, and then assume it goes down 1% every day for 10 days, see where you are on the IWM, and then see where you are on the TNA under that same scenario. Or go up 2% for 5 days, down 1% for 5 days, go up 1% for 5 days, and then down 2% every day for 5 days. And just run some math numbers on the IWM and the TNA and just tell me what you get with the compounding nature. So it's a combination. It's a combination of compounding, and it's also a combination of the derivatives and the erosion that takes place over time. So just be careful. I talk sometimes about the TNA or the TQQQ or these leveraged products, but you really have to understand the risks. And that's why I like to spend some time talking about that, because anybody coming in new to the show thinks the TNA is just this ordinary stock, which it's not. It's just a product that's designed to track the IWM over a 1-day period. That's all it's designed to do. So if the IWM goes up 1%, in theory, that day, the TNA should be up 3% or pretty close. That's all you get for certain. Beyond that, you're taking a risk with leveraged products. So you need to understand how they work. A lot of times when the underlying index goes up every day, you get a compounding effect on that 3-to-1. And sometimes you actually do better than triple. I've seen that before and actually experienced it before. So if you get the uptrends, that's perfect for these leverage type products. And I don't mind holding them longer term as long as I feel like I'm in an uptrend. Once that uptrend breaks, and I think the first sign of that would be a close below the 20-day moving average on the underlying index. Once that takes place, then I think you got to be really careful with these. What else do we have? Let's take a look at the transports. So there's transports continuing to move up. Yesterday, like I said, was a down day, so we lagged in the transports. But this is a group that has been leading the S&P 500 for the last few weeks. Actually, let me go back to that TNA, that triple. I'm going to pull up the transports, and let's see what the transports have been doing over the last 15 days. They're up 9.06%. And then you got the TPOR, which is the triple transports, up almost 30%, 29.90. So you're getting more than a triple out of the TPOR, which is the transportation bull 3 times. Now, I like to have some volume. And also, I don't know what the spread is. A lot of times, if you don't have much volume in the leveraged ETFs, the spreads sometimes can be pretty wide. So that you're paying maybe 50 or 75 cents, the bid and the ask are 75 cents apart. That's a cost of trading that you need to be aware of as well. Because if you buy a stock, if I were to buy the IWM and then turn around a minute later or even a second later and sell it, I don't lose hardly any money. The IWM is going to be separated bid and ask by 1 penny. The TNA is going to be very similar. It's going to be 1 penny. But if you get into something like transports and you jump into the TPOR and then you decide for whatever reason, it takes a little bit of a move down and you want to get back out, you're going to take a pretty good hit just based on the spread between the bid and the ask. That's the other thing to watch and be careful about when the leveraged ETFs don't have a lot of volume. You got to kind of watch the spreads. And so that can be a deterrent for me. All right, 10-year Treasury yield. So let's take a look where we are here. Right now, we are at 441. Now, this is, again, on the heels of the inflation report coming out. You can see a turn to the downside, trying to work our way back up, but we did already put in a lower low. My guess is the yield goes lower today. That's what I would expect when the core CPI comes in lower than expected. Tells us inflation is not as much of an issue. Normally, what we would see is the 10-year Treasury yield moving down as more and more money rotates into treasuries. Because if inflation is not a problem, jumping in and getting that current yield is not a bad investment, especially for somebody fixed income. So anyway, that's the TNX right now. We'll see where that goes. For those of you that are new to Earnings Beats, I just want to mention, please like the video, subscribe to our channel. That will help us in the algorithms here on YouTube. So that's one way you can certainly support us at Earnings Beats. Make sure you like the video, subscribe to the channel. And then if you want to come over and see what we're all about, we have a 30-day no-cost trial that you can sign up for right there. We also have a free newsletter, completely free, no credit card required. We've had tens of thousands of folks subscribe to this newsletter. Name, email address, that's all it takes. And then you're set. And we'll send out a article to you. I call it an article. It's 2 paragraphs in a chart. So if you like to trade, there's a lot of individual stocks that I feature that you can trade. Obviously, that is on you. We're not registered investment advisors. I'm not following the trades. I'm just providing what I see at a moment in time. But sometimes these work out really well. So you have to, maybe consult your own financial advisor before taking a position. But anyhow, it's done for educational purposes. We try to teach what we feel is important in the stock market. And if you've been following us for a while, you know that we've done a pretty good job and are very trustworthy. But anyway, you can check that out. Also, right now, there's an area, and I've been talking about this somewhat, but I believe still we could see 50% gain by year end, or certainly within the next 12 months. And if you want to find out what I'm talking about, just go to our website, click on that. It'll take you to a page right here where all you have to do is sign up with your name and email address. Got a nice little video there for you. And then after you sign up, I'll send you a lengthier video and talk to you about this asset class. Not only, giving you the asset class, but I'm going to explain to you, I'm going to show you why I think it's going to go up 50%. or more. I mean, it could be 100%, but let's just go with 50% over the next 6 to 12 months. But check that out. Pretty bold call, but I'm also pretty confident about it. And, you can always write into support@earningsbeats.com. Let me know what you think of the video and the projection. But anyway, make sure you check that out. It's free. So there's no cost to get that information. All right. It's 9:30. Wanted to mention, first of all, Trade Desk was added to the S&P 500. So we're getting a nice pop there. And we opened above key resistance. So it looks to me like probably now the worst is behind us on Trade Desk. I'd like to see how it finishes today, but a nice solid finish above 85 would be more bullish than the alternative. But I do think things are improving at Trade Desk. And this is a company that if you go back, 20-year monthly chart, you can see has had a huge run to the upside. It's gone through some issues before. It managed to hold on to this long-term support around 40. So I think it's probably going to consolidate in this 40 to 140 range. But I would not be surprised to see this continue to the upside. And being added to the S&P 500 is just meaning that we're going to get a lot of buyers. So it's all good there. What else do we have here? Talked about NVIDIA. That was obviously in the news. Oh, earnings. JP Morgan was down this morning pre-market. It was down a couple of bucks, $2-3 after they reported earnings. Earnings came in better than expected. So it looked like maybe just a little bit of sell on the news. But we have now rebounded and we are higher by about 0.2% on JP Morgan. And of course, Jamie Dimon was his normal bearish self, talking about all the problems we have and everything that can go wrong. But that's just Jamie Dimon. He's done a great job with the bank. You can see now jumping a little bit more, up almost a full percentage point. Actually pretty volatile, back down again. But still up over $2. Wells Fargo, another one, reported earnings. That one is down about 3%, back down close to that 20-day moving average. I actually think that's a buy. I didn't see what their numbers were, so I'm not sure if they beat expectations or not in terms of earnings and revenues. But the stock was down. And if you want to look, I'll tell you what, I'm just going to go ahead and pull this up. Where I get my information from is Zacks. So if you go over to Zacks.com and to go into earnings, you can go into earnings calendar. I do earnings releases. And then for today, we should see earnings surprises, positive, put it in alphabetical order. Citigroup beat 35 cents, 196 versus 161. There's JP Morgan, easy beat by more than 10%. Wells Fargo, easy beat. And interest rates, folks, interest rates should come down in the second half of the year, increasing the spread for financials, for banks. So these good numbers are only going to get better. I expect banks to continue to perform extremely well in the second half of the year. So anyway, all beating on the bottom line there, which was nice to see. Let's see. Let's take a look at Citigroup. Citigroup breaking out up 2.70, now 2.8%. So pretty good move there. Let's see what the overall banks are doing. The KRE was down earlier, but now it's still down, but only down 7 cents coming back. Go to the intraday. It was down earlier, trying to make its way back to the upside. And let's take a look at the small cap IWM. Gapped up over 224. Now it's back down to 223. So that means the TNA is doing pretty good today. It's up 0.4%. So it's down off the high, but still trying to hang in above where it closed yesterday. Trying to think of biotechs, which had been doing pretty well. XBI gapped up, coming back down though now. I don't know. Let's go back over and just see what the market's doing. We'll wrap this thing up. So we got the NASDAQ up 164 points. So getting a lift primarily from NVIDIA. I will come back to this. Let me just see NVIDIA real quick. NVIDIA up 4.45%. And over here on the S&P 500, you can see Advanced Micro Devices leading, up $10. That's up 7%. AMDI. SMCI is starting to make a little bit of a push. This is one that got beaten down by accounting irregularities and all that. SMCI, though, definitely making a pretty good push today, looking to extend its push to the upside. There you can see Citigroup with its solid quarterly earnings in the top 10, making a move to the upside as well. So anyhow, market getting off to a pretty decent start this morning. We'll see how it finishes today. But all in all, CPI came in tame once again. Core CPI, if you're late to the show, core CPI this morning came in below expectations, rising 0.2% versus 0.3 expected. Are you listening, Mr. Fed? That's all I got to say. Have a great day, everybody. Happy trading.